You might not be able to notice, so let me point out for you. This is a news article not from recent times, not from this year, not from past year, but rather from 2014. So why is it present here today? It is present here today because it is a possibility that this exact line might be coming up in future, where India yet again becomes part of or a component of fragile 5 economies. Hello everyone, welcome to Vajiram and Ravi's Flash News. My name is Shubhangi Singh, and in today's session we are going to understand that why are we saying that India is going to be one of the economies amongst the fragile 5 economies. What are the things that are lying in front of us that are indicating so, and most importantly, that what exactly is a fragile economy. Now the first thing that you need to understand here is why this discussion has come all of a sudden that India belongs to the category of 5 fragile economies. So the trigger to this situation is something that happened on 30th April. When we go to 30th April, what happened on 30th April? 30th April marked again the crossing of 95 rupees per dollar mark, and rupee recorded a record low yet against dollar. So rupee touched this mark, went beyond it, as of now thankfully operating at comparatively lesser. But when we put this in a pattern and try to understand the trend, you might be able to see that in 2025 we were talking somewhat about 85 rupees per dollar. We started 2026 with depreciation of rupee, where 90 rupee per dollar came the situation, and as of now 95 is something that this is not the first time that rupee has been, this mark has been crossed. This has happened in March as well, and especially since Iran-Israel-US war broke out, this seems like a plausible situation that it can happen anytime. Now when we see this trend, this shows that our currency as of now is depreciating 12% every year. Whereas before this, if you look at the average depreciation for almost 3 to 4 years was 3 to 4%. Now when we are looking specifically at 12%, this is where the comparison I am bringing for the fragile 5 economies, because the last time India was labelled a fragile 5, part of fragile 5, was back in 2013, and that was a time that similar currency stress episode was seen, and that is why this question has come up, that is India returning to the vulnerability that brought it the tag of fragile 5. Now to understand this better, we have to start with understanding what exactly is fragile 5. So fragile 5 is nothing but a term given by Morgan Stanley in 2013 to 5 economies that were seeing heavy currency depreciation, which included India, Brazil, we had Indonesia, South Africa and Turkey. Can you tell me in the comment section the currencies of the other 4 countries? India, I am hoping that you know that it is Indian rupee, but can you tell me the currencies for other 4 countries in this context? So when we are looking at these countries, on an average they were seeing more than 12% of depreciation. For some countries it was way worse. And this was not the only core characteristic that was observed while labeling these 5 economies as fragile 5. Another core characteristic that was seen, that they had high current account deficit. That means their imports were more than exports, and that is why they had to pay dollars, because exports help you earn dollars, imports help you spend the dollars. So because you are spending dollars more, there was net dollar outflow. But if you have limited dollars, how will you do this? You would have to rely on your foreign exchange reserves. If your foreign exchange reserves are not enough to manage this, you are in a crisis-like situation. Another way to ensure that this outflow can be facilitated is that you have investment coming in form of dollar. That can be seen through FDI or FII finance. And then we have another characteristic that all these economies showed extreme external vulnerability. They were extremely sensitive to anything that happened in the global financial market, any change in interest rate that could take place or capital outflows. And as a result, they were placed here. And I will point out to a very important event as well, which showed not just this but explained the vulnerability of fragile 5. Now let us straight up move to understand this better to 2013 crisis that we are talking about, and that will give you a very clear comparative analysis in the end. When we are looking at these characteristics, this is what exactly led to the crisis. When we are looking at 2013, we have to understand that the trigger event here was a change in global interest rate factor that was coming from US. Federal Reserve went into quantitative easing tapering signal. Now for this we need to understand that what exactly is quantitative easing. Now when we are talking about quantitative easing, it is basically central bank printing more money so that more liquidity is injected into the economy. Now this is where we get to see that initially there was a quantitative easing phase where cheap US dollar was available and there was liquidity across the globe. Now because of this, capital was moving towards emerging markets, including the 5 economies we just talked about. And once this phase ended, when Federal Reserve brought a signal that we are going to roll back the quantitative easing that we were focusing on, US interest rates were expected to rise, and any investor who is in emerging market, who is holding some risk, would rather like to move to a solid market where the returns are better and promised, and that is why the US assets become more attractive. Now when we are looking at the economies which are heavily dependent on dollar outflow and their source of income was investment, in that FDI is stable but FII is not stable, and this led to outflow of FII, and that is what came into the picture as 2013 crisis. The moment there was change and the movement was seen towards US, the demand for US dollar increased, the supply of US dollar was already low in India, and that is why rupee depreciated sharply, and similar things were seen in other fragile 4s. Now this also shows us currency movement, right? Now but this currency movement was again a sharp one. So when we are looking at currency movement, it is not just a surface indicator, rather it reflects deeper macroeconomic realities, and we have to understand that gradual depreciation might be normal. It shows that there is inflation differential, it shows that there is growth dynamics, but at the same time if there is a sharp depreciation in front of us, it is a stress signal, and this stress signal surfaced back in 2013 and it is surfacing again, because 12% fall is not routine, it indicates external sector imbalance. Now when we are looking at external sector imbalance, it can be understood through this very simple equation in front of us, that when we are talking about balance of payment, it has two accounts, current account and capital account. If current account deficit is there, if you look at India's situation, we have high imports and we have comparatively limited export growth. 2013, yes, weak export growth, but we are still having a lot of potential that we need to utilize. This is okay, this can be managed, but if this also exists, FII outflows also happen and investments reduce, this leads to a twin stress situation. And here comes our savior, which is our central bank, Reserve Bank of India, which focuses on Forex reserve drawdown, which gets the dollar out of foreign exchange reserve to stabilize the rupee and make sure that the currency becomes stable. Or if we had a fixed exchange rate system, currency depreciation is also an option which we have used before 1991. Now this is the place where you will get clarity in terms of difference between 2013 and 2026, because This might be similar for both years, but this is something that is different. We are comparatively better situated in terms of our capital account, and also when you look at adjustment mechanism as well. So if you are looking for an answer, I will be giving that. Is it similar to the situation of 2013 or not? But before that, let us do a face-to-face direct comparative analysis. So as of now, if you are looking in terms of depreciation, yes, rupee has depreciated 12%, that is true. CAD pressure is emerging because of multiple factors. Can you tell me in the comment section? We have covered multiple sessions about CAD, that why it is being generated. So let me know in the comment section. Capital flow, volatility is present, but extreme pressure is not. We are seeing outflows given in extreme situations, but that doesn't mean we are out and about in this situation. And we can understand that BOP stress is also emerging, which is all of this remains similar as compared to 2013. But if you look at the current situation, the currency depreciation that we are talking about, yes, India, it is 12%. But if you look at other countries, it is very different. The worst performing scenario here is only for Turkey. India is the second worst performer here. Apart from that, when we look at the reference exchange rate of rupee against dollar and other important currencies, in this context, yes, again, we get to see that there are very similar numbers in front of us. But at the end, we also have to focus on differences. Because when we are looking at nature of decline, 2026, it is sharp, but it is very recent. Forex reserves are extremely high as compared to 2013, and most important factor, macro stability is relatively stronger. So yes, the situation in certain aspects are similar, but the difference also needs to be understood. In this context, yes, the fear is right, but when we look at the clear signs, it is not a full-scale 2013 situation. What we need to focus on? We need to focus on reducing the CAD. We have to focus more on boosting export. We have to focus on capital stability so that we have stable, that is FDI, foreign direct investment, focused more, and then Forex buffers are going to be our savior any day, anytime, anyhow. And all of this needs to be driven by the market as well through structural reforms where the market is also growing, not just the rules are changing. Now that was all from my side. What was your thought on this? Let me know in the comment section. Thank you so much.